Ed Clissold is the Chief U.S. Strategist at Ned Davis Research. Ed, let's talk about the market overall, because I like your points here about what to look for when there's a bottoming process, a capitulation trade. You've outlined some steps for our viewers. Walk me through them.
Yeah, so each cycle is different, so we don't want to get too hung up in the details, but in general, the market follows a four-step process. Number one, the market gets oversold. Number two, there's a reflex rally. Three, there's a retest. And finally, you get breadth thrust on the other side. So clearly the market has gotten very oversold. And we've even had a few rebounds and rallies and even some retests. Now, what you want to see in those rebounds are a lot of participation, a lot of stocks moving up together. And then on the retest, you want to see the opposite. You want to see fewer stocks making new lows. You want to see less volume. Even if the Dow, the S&P, the NASDAQ make new lows, if you have fewer stocks participating, that's a good sign. Now, you can go back and forth, have several of these steps 2 and 3 along the way. And then on the other side, the breadth thrusts mean you get a lot of stocks moving up together. You can get 90% of stocks above their 10-day moving averages and statistics like that tell you you're pretty much in the all clear. So that's what we're looking for right now. We're kind of in between steps 2 and 3. The rebounds have not been particularly encouraging to us. They haven't been expanding. But on the other side, the declines in the retest haven't had expanding new lows either. So I think the market's trying to find a footing here, and we'll keep monitoring those steps 2 and 3 as we go.
So the step one, the oversold, that one was pretty obvious. We went from like the most overbought to the most oversold in a day, I think. Then the rebound, maybe last Friday up until yesterday, or rather Wednesday, possibly. The retest, though, Ed, if we break through a new low today that we've had post-coronavirus, does that mean that we are very much sort of does that set us back to step one? I know that we bounced back from oversold, but if there's no bottom to test because we take out a new bottom, where does that leave us in this system?
Well, I think your thought process is exactly right, Oliver, that if you break down, then you do need to go back to step one. So that's a possibility. But what we want to look for is to see how that plays out in terms of market participation. So I'll use a huge example for you because the technicals were very clear. There were 3 big lows in late 08, early 09. You had the Lehman low on October 10th, and then you had another low on November 20th, and of course you had the final low on March 9th of 09. Well, on that November 20th low, China, several commodities did not make new lows. And then from the November 20th 08 low to the March 9th 09 low, 2/3 of the decline in the S&P were due to 2 sectors. Financials and discretionary. Most other sectors held up. So that's what we want to look. So I'm not going to get too hung up on one cap-weighted index or a price-weighted index even as the determinant of whether or not it was a successful retest. We want to see how the average stock is doing. And we may get a lot of good information today, good being we'll get some information, whether it's good for the bulls or the bears, it remains to be seen.
Ed, you talk about the breadth thrust. You've got a chart that characterizes this. What exactly are we defining as impressive right now, given the overall breadth on the downside that just saw so much getting slammed? I think at one point there was only like 5% or something of the S&P above the short-term average. I don't know. I lost track of some of the stats here, but it was a bloodbath. So what do we see in terms of the pushes that we've had? Are they impressive at all? The push last Friday, the push this week?
They've been fair but not great. So I'd say we certainly are a long way from a breadth thrust. So I'll give you one stat. You want to see advancing volume, that is all the stocks went up in the day. What's the total volume of them? And then you look at all the stocks went down in the day. What's the volume of them? And if that advancing declining volume ratio gets above 10 to 1, that's a breadth thrust.
Okay,
and,
we're looking at this right now.
Haven't gotten that at all this week. So it hasn't met that criteria. Now, in order to get the all clear, we'd want to see 2 10-to-1 up days without a 10-to-1 down day in between. But no, I wouldn't say this week what we've seen are really along the lines of a breadth thrust. Not quite enough yet.
Yeah, all right, and we're looking at that. The bottom panel here of your chart shows those thrust days in the December 24th Christmas Eve sell-off. We bounced back pretty big the next couple sessions. As you can see on the bottom right there for our viewers, we're not even close to that right now. A decent day, but one that doesn't compare. We're going to open up the bell here for 30 seconds, Ed. I want you to stick with us with another point. The 10-year yield is going to right now trade below 70 basis points. Ed, I hear a lot about how lower yields mean dividend payers, the classic Fed model means good things for stocks. Does that still apply when the yield is dropping like a rock because fears of a global shutdown of activity? I mean, come on, are we really going to use the Fed model, the Tina trade here?
Yeah, I think the Fed model has been proven to not be a great timing tool for the market. Throughout the 2000s, first decade of the century, it was telling you to buy stocks when you shouldn't have been. So no, we're not too crazy about the Fed model by itself. But I think from a broader perspective, low interest rates mean that if you're an investor that's looking for income, you gotta look to stocks. 70% of S&P stocks have dividend yields greater than the 10-year Treasury. That's a record high.
Wow.
So that's the challenge as an investor. We may not love stocks because they're expensive or other reasons, but if you want income, where else are you going to go, right?
Right.
But
so it's eventually, basically, it's not now, it's not timing, but eventually it should come home to roost.
Yeah, that's exactly right. I think we're going to have to get through all the uncertainty over the coronavirus, but assuming the dividends are in fact safe, then it's going to be a powerful driver of equities perhaps later on in the year.
Ed, before you go, we're out of time here, but I got a chart that you have about earnings. I want you to walk us through this real quick because I think it's important. How much are 2020 estimates at risk? I know there were expectations for big growth this year. What do you see right now? Walk us through this real quickly.
Yeah, I think, so these are showing consensus estimates. So the first half of the year, Q1, Q2 have already come down quite a bit. Those probably are at risk even more. I think the second half is going to be the interesting story. If Corona bleeds into the second half, those numbers, which are pretty high, right? We're in the mid-teens, upper teens. If those get hit harder, I think that's going to be a challenge for the market. So that's what we got to look over the next several months.
So it's getting pushed back, basically. The dashed lines here are for the 2020 expectations, and the 4Q is still looking for some pretty big growth. Is it 18%? Am I reading that right? That's still expected for 4Q and 14% for 3Q?
That's exactly right. That's what consensus is showing. Now, I think most people don't believe that. Analysts just haven't bothered to lower the numbers yet. And we're going to get a real good idea in the next few weeks as companies go through the pre-announcement period, whether or not they take down just Q1 and maybe Q2, or if they take down the whole year. But clearly those second half numbers would probably need to come down regardless of Corona. And we'll have to see if how much they're going to come down.
Okay. Ed, great stuff. Really love the research, as always. Very helpful to us as we try and put together a very confusing time. Bonds opening with some serious steam once again. Ed Clissold, Chief U.S. Strategist at Ned Davis Research.